Most investors see media coverage of company X or company Y having revenue jump of 200% or profit jump of 50%, and they think that's the next best stock idea they should invest in. Here's a differing school of thought. Revenue and profit are an opinion, whereas cash flow is a fact. I've seen many companies that had record earnings and record revenue growth, but actually their bank accounts and their cash flow are actually bone dry. In this video, I'm going to show you how to differentiate a company that's running on fumes and a company that is really running on solid, rock-hard cash flow. Stay till the end of the video to equip yourself with the skill set to differentiate these companies within 5 minutes. Hello everyone and welcome back to my channel. My name is John, former engineer turned full-time investor, licensed financial planner with the Securities Commission of Malaysia, and currently wealth planning director at Phillip Capital. I'm also the author of an upcoming book called The Malaysian Multi-Baggers that should be out in stores very, very soon. So there's actually 3 parts of one big financial statement, while most people actually view it as 3 financial statements. Now, the reason why I say it's 3 parts of one financial statement rather than 3 financial statements is because the 3 financial statements should be read as one, rather than just focusing on one part, or usually the income statement or profit and loss statement as just that one, or be it all financial statement. In the income statement, there's actually 3 main things you need to focus on only, which is the revenue or the sales, the expenses it used to generate that sale, and last but not least, after netting all the expenses, what is the net profit of the company? The problem will begin because of an accounting standard called accrual-based accounting. The net profit statement does not actually show the movement of cash. It just shows whether a product is being sold or being billed, and all expenses have been accounted or accrued for. So your net profit isn't really showing the movement of cash or whether the company actually received cash within that accounting year or that accounting period. So that is where the problem lies, is because most media actually just focuses on the income statement. They'll tell you revenue has jumped a certain percentage or profit has jumped a certain percentage. But does it really show whether the lifeline of the company, in my case, cash flow of the company, actually moved into the company accounts? That is where we move into the second part, which is the cash flow statement. Now recall earlier I talked about the income statement where I showed sales and mentioned about net profit, but actually not really showing movements of cash. That is the danger of paper profits, because in the income statement, it is really just movements of paper. Think about how businesses are run today. Most of the suppliers of a particular business are actually not paid in cash terms. They're actually paid on credit terms. That means you take inventory or you take raw materials from your supplier. As a business owner, you only pay them probably 30 or 45 days or even sometimes 60 days later. The same happens to your clients. You bill your clients, you deliver the product. However, the clients also require you to give them credit terms. On the income statement, it is actually already recorded that the sales has begun or already done. And the expenses, even though they have not been paid to your staff or to your suppliers, is also recorded as an expense. So the final number of that net profit does not really, it shows a number, but it's actually not showing the movements of cash. So it is actually very easy to manipulate because invoices could be fake. That's a very, very prevalent practice. The second thing is, how do you actually recognize revenue? So some companies, they are on a subscription basis or they are on a contractual term basis where the project actually requires 5 years of service delivery or construction or whatever. However, they bring forward or they aggressively recognize that the sales within the first year of the project or within the first financial year. And a 500 million project that should be recognized across 5 years is now recognized within a year. But then it's an easy story to sell because, hey, I've generated the sales and my sales number has actually grown up, and that is used to entice people to actually invest in this company where the revenue shouldn't have been such so aggressively recorded. And that's where, if you just focus on the income statement alone, you will be very easily misled to seeing this huge jump in numbers. And that's where focusing on the second part of the financial statement, which is the cash flow statement, will actually help you differentiate companies running on fumes and those running on real solid cash flow and not aggressively recognizing their sales. So there is a rule of thumb that I use. It is actually, if a company makes $1 in sale, the amount that their clients actually owe them, or this line item called accounts receivable, it should not exceed 20, actually to be conservative, should not even exceed 15% of the sales generated that year. So if you're doing $1 in sales and your accounts receivable is actually 20 cents or even 30 cents, then I already start seeing that as something to be aware of. Because if your product is so good or your service is so good, why are you allowing your customers to owe you 30% of the sales you make, 40% of the sales you make within one financial year? By right, you should be collecting within 30 days or at most 45, 60 days. Obviously, in bigger or more long gestation industries like construction, there is a different way or different term. But by and large, within one financial year, if a company needs, even to recognize 100% of their sales in receivables, that for me is a very, very, very big red flag. I mean, can you imagine you make $1 of sales and the customers owe you $1 after 1 year? Is that really a way how you should run your business? So the second part, the second triage that you have to look at in a financial statement is the cash flow statement. That is the lifeline or the blood circulation of a particular business. You ask any genuine businessman, they'll tell you profit doesn't really matter, but cash flow matters, because that's what is used to pay utility bills, pay the salary, pay your suppliers, and pay for everything else. That is the real lifeline of a company. The third part where you can pick up whether the company is running on fumes is this. Let's just say this company actually booked record revenue, record profit in their income statement. And yet when you go and see their cash flow, you don't see much movement of cash or cash flow from operations into the company's cash flow statement. Then you have to think back and relate. It's a story, it's a translation game. If you don't have, let's just say you're a salaried guy and you are promised a salary, but you never get paid salary. Your cash flow is zero in the bank, in your current account, your savings account. How do you survive? You start either withdrawing from your fixed deposit or your savings, your backup savings or emergency savings, or you start borrowing money. And this is where the balance sheet will help you recognize whether the company is borrowing money to survive, because it still needs to pay staff salary, it still needs to pay utilities and all that kind of thing. So start looking at the balance sheet and see whether they are borrowing money. Look at their cash and equivalent, and look at their debts. Are their short-term debts actually growing? Are their long-term debts actually growing as well? And that's why reading the financial statements concurrently as one, rather than just focusing on the income statement, just looking at sales and looking at profit, will really tell you the whole condition, the genuine condition of a particular company. And from there, right, you will be able to see, hey, over 1 year, 2 years, a very well-disciplined, very well-run business, you will see that the three financial statements will line up. They have growing sales, may not be, a volcanic or may not be erupting any one single year. You will maintain somewhat of a steady growth, right? And then you see cash flow from operations very healthy back into the business. And you will see that the balance sheet is almost pristine, meaning if the business is so good, they're generating cash flow, why do I need to borrow money? In fact, they'll be piling high in terms of cash and they don't even need to take on debt to run the business. And that's where a lot of people, if you hear the term, this term called net cash company, this is exactly what I mean by that. Because there's so much cash flow generation from the business, they actually don't need to rely on bank borrowings or debt to actually grow the business or to survive. And that's where, when you read the three financial statements as a whole, then you really get a better grasp of whether this business is here for the long run. Because yes, I know some people will say, we just buy based on the jump of profit or jump of revenue this year, and then we'll sell it as fast as possible. The thing is, how do you know you're not holding the short end of the stick at that point of time? Everybody thinks they can outsmart the system and try to get out before everyone gets out. But yeah, maybe you can make 10, 20%, maybe 100% if you get very, very lucky. But if you want to make life-changing money, it's really in the long game and multi-bag your returns. And in order for you to play the long game, you have to make sure that the company is playing the long game with you and doing business sustainably over the long period of time. So there you go. I think that's a quick 5-minute roundup of what I described in my book as well. I don't go into very much detail because I think these are preliminary or foundational criteria or skill sets that you need to have to evaluate a company. What I focus more in the Malaysian Multi-Bagger book is more about the quality of the businesses. Now you've got the basics right. Now you know cash flow from operations is really the lifeline or the lifeblood of the company. How do you sustainably grow and scale the business? What kind of quality of management do you need? What kind of industry tailwinds do you need? These are covered in more detail in the book because I believe these are the criteria that will help sustain a company and scale and grow it over the long term. And that's where you get your multi-bag return. Now, what do you think? Do you think these skill sets are difficult to acquire? And now with the help of some ChatGPT or some AI tool, I think it's much easier to get these tools to actually teach you or to give you case studies or examples. I mean, when I first learned this about 23 years ago, it was all alien jargon to me. But now with abundance of social media material, abundance of AI tools, I hope this can hasten your speed in being a smarter investor. I'll see you in the next video. Let me know in the comments what do you think.